Good morning. It's Monday, the 22nd of May. This is Jim Riggio, and today this is the Monday Market Muse for Capital Discussions. Capital Discussions is not a broker-dealer or investment advisor. This presentation is for educational purposes only. We have no way of knowing your situation or what level of risk may be appropriate for you. We're not making any trade recommendations. The risk of trading options can be substantial. Please be aware of all risk prior to placing any trades. Any of the hypothetical computer simulated trades that we discuss here are believed to be accurate. However, actual profit and loss will vary due to many factors such as liquidity, slippage, and commissions. We had an interesting week last week. When we take a look at what had been going on, and what I'll do is I'll probably take about 10 or 15 minutes just to kind of go over the technical analysis really quick. Again, for those of you who are newer, okay, to Monday Market Muse, and when I do the technical analysis, the blue lines are long-term trend lines. The shorter term, meaning less than 2 years, are upward trends are going to end up being in this magenta. Downward trends are in red. We don't have any long-term trends because we are near market highs. If I end up showing you these lines, and let's get into this past year, you can see that certain lines like this right here, which was support at the bottom when we hit our lows in February, support at the bottom when we hit our lows after the Brexit vote. In the U.S. election, we got through it. You can end up seeing that it acted somewhat as resistance as we try to end up getting back above it. However, longer term lines where we end up going from the tops that we had last year, the top that we had in April, the other top where we ended up having here during August, and again, very close to it in December, you can end up seeing that this was a very important line that came and actually is probably going to act as resistance now. Okay, that's why this becomes very, very timely when you take a look at the run-ups and the run-downs that they end up having in the market. The other line that was very, very important, and if I end up highlighting just this past year, you can see that the support that we had from the very end of last year, 2016, you can end up seeing that it was support levels multiple times. Even though we broke it here, we closed above it. Once we broke it, it was support. What I wanted to end up showing you was a couple of things. Since we spoke last week, we talked about these two gaps. This was after the first French elections. This gap has filled. I can get rid of that one now. This gap has filled. I can get rid of this one now. And when we had the big sell-off after the Trump-Comey dance that we did last week, you can see that there was a big sell-off with a gap. And so filling the two gaps that we had below us, which was something that we talked about would be very healthy, we said that we would find support somewhere in the, 23, 50, 52 area. Look at this line, okay? You go back in the videos. This line has been drawn here now for, months. We came down almost perfectly to touch it. Now, what ends up happening many, many times is that they become close, right? We came within 69 cents of touching, okay, that line. They're never going to be perfect. They're general areas. They usually are not that specific. When you take a look at where we opened this day almost perfectly on the downward trend line. That's why the trend lines, okay, trend lines and price levels are the most important things. You can take a look, and I'll go through, some of the different studies and the stochastics and the MACDs, and we'll take a look at linear regression channels. But it is the learning how to end up drawing these lines and seeing the patterns is, I think, the most important part of the technical analysis. So we had this sell-off, which was great. We ended up very, very healthy to fill these two gaps. Now we left this gap above us. We're running into some challenges here, okay? The first one is that when we take a look at that long-term trend line, okay, this one here, not so long, right? This is the one that I agreed that we said was going to be less than 2 years. And let me just move it so that I want to move it this way. 30 seconds. There we go. Okay, so when I end up taking a look at, if we end up going back a little bit to here, right, you can see that this was the trend line. I need one more. Okay, you can end up seeing that this was the trend line of the highs that we ended up having last year. And so when we take a look at what we've done so far this year, we have this trend line that's acting as resistance. We have the lows for 2017 trend line. This magenta color one, that's also going to end up acting as resistance. And both of these trend lines went straight through a gap, okay, during the Trump Comey dance that we ended up doing last Wednesday. And so when I take a look at this, obviously we're not going higher, okay, without filling the gap. If we do end up going lower again, we'll have left a gap above us. And I don't like leaving gaps when you have this type of movement. I've gone over this before, but it's worth saying again in previous. The only types of gaps that have a reasonable chance to end up filling, meaning that they're not very high probability gaps that they do get filled, right? This is a very high probability gap that it's going to end up getting filled. These two are not. Okay, let's take a look specifically at the Brexit gap. After we had two horrific days of selling, we had a gap back up. So there's not a tremendous amount of traffic that's been in this area. There's not a tremendous amount of battles that have gone on where people have bought and sold. And so when we gap right over it, it can happen, especially when you're coming bouncing back after a really bad sell-off. So these are the types of gaps that they usually do get filled. Don't get me wrong, but they're not the almost certainty to type get filled like we have here or like we had in these two. And so, will we end up moving up? Yes, we'll move up. Okay, if you take a look at the lower resistance line, which is this one right here, which had been support and now is resistance, it's moving up towards 2400. We'll end up being there literally tomorrow. So, we're probably going to end up fighting again in that 2400 to 2405 type area. Remember, they're never going to work perfectly. Many times you'll hit a resistance line, okay, play it a while and then come off. Same thing with the support line. Many times you'll sell off into a support line. You can end up breaking for a little bit and then bounce back. What ends up happening these days is that there's so many algos, right, and so many computer high frequency trading systems that they all know where these lines are. So many times what they're doing is that they're stop hunting, right? They're trying to get as many people to end up giving up their shares at a certain price, whether they're trying to get them in or get out, it depends. Over here, are they going to try to end up getting new people to end up coming in? Like, for example, there are probably a ton of people who won't end up getting into the market until we end up breaking the previous highs. Okay, so you get to 2406, 2407, you're probably going to have a bunch of orders to end up getting into the market at that point. Do they go? They try to end up taking all of those. Those are called buy stops, by the way. Don't buy until we get up to this level. Will they go stop hunting is the term that we use. Don't know. It happens all the time. Trying to figure out the exact point is sometimes difficult. Just know that you're in an inflection point if we move up to that area. What happens once you end up getting to that area? You'll usually end up, it'll become a battleground. There'll be some back and forth, but once we move off of it, you can move off of it quite substantially. We talked about the trend lines that we ended up having that we had drawn previously, and we had this flag pattern right in here, and meaning if I used this trend line, right, the one that is the highest on the left-hand side of the graph, but at this point has now become the lowest. When we take a look at that flag, how well that ended up working for the last couple of weeks, that we gapped up to it, this happens many times where you'll end up getting pushed within the flag. It'll get tighter and tighter and tighter, and then when you finally do break through it, many times you get these crack and snaps, moving it above it just a little bit. But when you move away from it, you usually move away from it with some velocity. And that's exactly what happened with our selling. And the fact that we moved away from this trend line with velocity right down to the next trend line, is kind of just another situation where it's showing proof that this is the way that most of the trend lines and the and the high frequency trading and the algos work. The other one that I end up drawing is a little bit shorter term. I like to end up seeing channels. Here is over the last 2 years the channel in the blue going up that we end up having pretty well defined channel. I have to end up saying that we were in it pretty tight. If I take a look at what's happened, this year when we did get above it and we had this blow off top. If you remember, we talked about the Ned Davis research of I forgot what the exact number was, but something like 15 blow off tops since the year 1900. Using the Dow because the S&P didn't go back that far, that almost all of those types of blow-off tops with a gap filled. This was another one that filled. When we ended up breaking through, okay, the longer-term upper trend line, we broke through it in a huge way back in late March. It ended up acting as support. It acted as resistance. It still acted as resistance even afterwards. We did have that downward channel that ended up forming. We had all of the lower lows, lower highs. We've definitely broken out of it. But now look, that's that same trend line that when we sold off, we ended up hitting the top of the channel. And so many times when you're looking at how do I end up looking, do I adjust a trade now? What I end up doing, and the way I think that the best advice that I could possibly end up sharing from my experience is that when I see a pattern like this forming, if I know that I'm going to have to end up adjusting, if we're up another, couple of points, I may adjust early. Why? Because it looks like we will end up filling here. However, if my adjustment point is, let's say, at 2,400, I may give it extra time, maybe to 2407, 2410, before I ended up adjusting, because I know that there's probably going to be a battle here, and many, many times we'll end up coming up to it, we'll bouncing off, and using that knowledge of where things are and where they'll probably move to becomes really, really critical. Okay. I'll just show you real quick, and then we'll open it up to questions. If I show you things like the oscillators. I think I'm just being a little bit slow. I have them listed, in my opinion, from slowest to fastest: MACD, full stochastics, RSI, using exponential moving averages, Williams percent R, and CCI. You can end up seeing that even the slowest one, MACD, while we did become red over here, and remember what it is, it's a moving average, convergence, divergence. And so the moving averages started to end up looking like they were going to roll over and start to get closer. But however, over the last couple of days, you can see that we're not the bright red. Let me highlight this. We're not the bright red bars, but the darker red bars, which means that while we're still negative, things are starting to get better. You can also see all the other oscillators have turned over and they're bouncing back up. The 20-day moving average in terms of the exponential in this lighter blue line has become support once again since we moved above it. So all is good in the world, right? We're above the 20-day, we're above the 50-day, we're above the 100, we're above the 200. I think it was Paul Demers who ended up sharing with me. He said the other day, he said, nothing good happens below the 50-day. And it's true, right? Nothing, at the very best, okay, you're holding on for support and you can bounce off of it. But obviously you have to end up breaking the 50-day if you're going to end up going down. And we've been playing with it, a few times. And so, but we're above the 50, we're above the 20, and so things look, all is right in the world again.
You do make major bottoms below the 50-day
yes, you do.
Average.
Yes, you do. One of the things that ends up happening is that I also look at two things when it comes to the moving averages. One is I look at their direction. Are they going from lower left to upper right? Are they sloped upward positively? Or are they going from upper left to lower right, sloped negatively, going downhill? Right now, they're all going uphill. Okay. The 20-day, obviously, the 20-day needs to turn before the 50-day. The 50-day needs to turn, and so on. But when you end up taking a look at this, the 20-day, even when it moves sideways or down a little bit, it usually waits to end up catching up. We haven't had a crossover on the 50-day and 20-day for quite some time. Let me go back and show you. Okay, the last time we ended up having the 20-day below the 50-day was back in November as we were going into the U.S. election. Now, this was all event risk driven. The event happened. The risk wasn't as realized or as bad as everybody ended up thinking, so we bounced back off of it. But even if I go and take a look at Brexit, look at what happened with Brexit. We came right down to it, touched it, and then came off. So without the U.S. elections, the last time I ended up having to see the 20-day when it got really ugly was at the beginning of 2016. Okay. And so right now, again, there isn't anything major that says, oh, I need to end up being worried. If I look at the linear regression lines, and let me come over to here. I break down the linear regressions. I use two different linear regressions, a 50 and 100. The dotted line, dotted red on top, dotted green on the bottom of the linear regressions. Solid, okay, line, red line on the top, green on the bottom of linear regression 100s. Yellow line in the center is the center line for both of them, okay? The curved green and the curved red lines are the Bollinger Bands. The center of a Bollinger Band is a 20-day simple moving average. And so if I take a look again at what's been going on here, we're up at the simple 20-day moving average, and we're approaching the center linear regression line. One of the things that ends up happening, and this has happened a couple of times, usually when you have a prolonged period of time, at least 20 days, right, because it's using a 20-day moving average, a prolonged period of time, you'll end up seeing things get narrower. Now, as big days, like 20 days ago, okay, when they fall off, you'll end up seeing the Bollinger Bands get narrower and narrower when they're moving sideways. However, even if you don't have huge days, but you have a trending market like we had here in February where we're moving higher, the Bollinger Bands get wider. Normally, when you get a contraction in the Bollinger Bands and they get very, very tight, that's the time when you end up getting bigger moves. Now, we did have some trending, first down and then up here, and the Bollinger Bands were getting wider. They should have probably even gotten more narrow if we hadn't come down, but look at what we came down to. We came down exactly to the Bollinger Bands and bounced back off of it. And so we're in a narrowing phase right now, which means as you're in a narrowing phase, market tends not to end up bouncing, not nearly as much. A slower momentum, okay, called a TTM squeeze, where things are getting better. They're positive and they're getting better will be lighter blue. When they're positive but not getting better, meaning that they're deteriorating, and they're deteriorating here because if you take a look, we had some sell-offs and then we had the big sell-off, and you can see that the blue lines dropped quite significantly here. They'll end up getting brighter blue. When we get down and things become negative, according to TTM, they get red or yellow. And so at this point, okay, I think we're getting very close to another significant point of inflection where we're going to either things are going to get, move in one direction or another. Let me just go back to this chart because I wanted to show you. Oh, no, not this one. I wanted to show you the trend, all of the trend lines. Okay. As we hit these trend lines up here and then the 2400, at some point during the next 10 points up, okay, the market's going to end up, okay, from here to the next 10 points up, there's going to be a little bit of a battle. And this is going to be now the third time we've played with this area, okay, this 2400 area. And we're going to end up trending off of it at one point or another. Either things are going to end up getting better in the economy, the geopolitical shenanigans, both in the U.S., North Korea, and the rest of the world, will end up slowing down and things will get better, or they won't. Everything will always be driven. Remember, everything will always be driven by expectations of how much money will companies be able to end up making. Okay. One of the big reasons why we've had this run right here, let's take it from the U.S. elections, is because of the expectation that corporate taxes would be lower. Okay, which means that companies would make more money, which make them more valuable. When you take a look at between tax reform we had in, I forget my exact years, but late 60s, early 70s, and then 1986, especially in 86, a lot of the corporate tax loopholes were, most of them were cut out. And so if they're going to try to make something revenue neutral, it's going to be difficult. There's no stomach to end up lowering corporate taxes and increasing personal taxes. They want to decrease personal taxes also, but with a $21 trillion deficit, it becomes difficult. So um, that's what's going to be driving the market more so than anything else. And the whole question on why we had this sell-off was, and I ended up mentioning this to on the special roundtable we did, was that it was really quite ironic to me. I'm not registered anything, right? I'm not a Republican. I'm not a Democrat. It's a lot more fun this way, by the way. It's kind of like going to a party when everybody else gets drunk and you're the sober one, and you look around and you see how silly everybody acts. That's the way I feel. Okay. Here's the irony as I was laughing to myself the other day. This big sell off here and the huge sell off that we had overnight on the election, when every pundit in the world said that the market would sell off between 5 to 10%. Okay. If Trump ended up winning, and it's going to be absolutely horrific for the market, we had this big sell off. Do you guys know why the reason we had this big sell off was? It was because now the market was afraid that we were going to lose Trump because we were going to impeach him. Okay, so to me, I just find the irony of it great. Here's a great trivia question. Now, who's the last president to get impeached? Type it in. Right? You know what impeachment means?
The last president to be impeached or to be convicted. Nobody's been convicted. We've had a couple of impeachments.
Mm-hmm. And there have been penalties for impeachment. Okay, some people have resigned. Other people have just accepted their penalties. Right. Last president get impeached was Clinton. That's exactly right. It wasn't. A lot of people always think, oh, it was Nixon because he resigned. No, I forgot what the penalty was for Clinton. Okay, because he committed perjury, said he didn't have sex, and he did.
He had to give up his law license.
Law license in Arkansas. All right, which he hadn't practiced in many years anyway. So I don't know how much of a yes, and he got censured. Okay, that's the penalty is called censures. And so you kind of take a look at it. What I tried to do very very hard was that I tried to end up watching the news media last week when this whole Clinton Comey dance was on, to see what new evidence came out. And some people say, oh well, an email came out about from Comey, but Comey ended up testifying in front of a congressional hearing that he wasn't pressured, a couple weeks before. So you kind of take a look at it, and it just seemed to me like a political grandstanding on both parts. So I didn't see anything that said, oh my God, this is new evidence that I really need to end up starting to worry about. Special counsel got put in, which is good, which ends up meaning that, truth will come out, but it's not going to come out tomorrow. It's not going to come out next week. This is going to end up taking months at the shortest. Okay. And so markets after the big sell-off, there was no other, shoe to drop after the sell-off. All that could end up happening is once a special prosecutor was appointed was that, okay, guy is respected by both sides, who they end up going, former FBI director, he'll start to end up looking into this. And now there's going to be political grandstanding, make sure he's got his resources and everything else. And so you kind of figured that there wasn't going to be another leg down because there was no new news to end up driving it down. And what's happened? We floated right back to where we were before the whole thing started. Okay, happens all the time. Okay, so the key is making sure that you don't get really hurt when things move. Now, one of the things I do want to end up mentioning here, because I was on the phone with several options houses, institutional traders on this day. Number one, okay, and let me show it to you. The VIX futures, the VIX went up much more than the VIX futures, but the contango never changed. Okay, you can end up seeing here. By the way, for those of you who haven't seen this, I tried to do closest to the colors of the rainbow as I could. The brighter blue, there was no violet. The brighter blue over here ends up being the shortest term. The red ends up being the longest term, and each one of these are months going back. This one started with the month that just expired. The month that just expired was May. The light blue is June. The fact that this thing came out on VIX expirations, if you're a conspiracy theorist like Paul Demers and I, Paul, I don't know if you're on, he's saying, yeah, I don't know. Did it happen? Was it an accident that it happened on expiration? Okay, for Wednesday. Remember, these expire on Wednesday, or not? I don't know. You be the judge. But look at how much the VIX. The VIX is the bars, right? Right, the candles here. The VIX shot up huge. Let me highlight this so it's easier to see. But the next month, and you can see the next month right here, by the way, the M. Oh, I can't end up holding it. But the M, okay, stands for June. Okay, for the June futures, it jumped. The Julys jumped. The August, the Septembers, the Octobers. Everything jumped, but we never got into backwardation. It's not like there was a great fear. And let's be realistic here a little bit, guys. We jumped off of a 23-year or close to 23-year low, if you're using the old VIX calculations, on the VIX. So the fact that we were up 40% and it made all this, we jumped the VIX, okay, front month futures jumped all the way up to 14. Oh my God, okay, panic, right? I mean, it's not that huge of a deal. Yes, we haven't had any sell-off. Things have been so freaking calm. That this ended up happening, which brings me to my next and my final point, and that is markets have moved from the way they used to trade. They've moved from having a market maker based system where market makers would end up making markets and you'd end up seeing them move things pretty quickly, to now having computers drive everything. Okay. When the computers drive everything over the last, I'd say, they've been doing this now for at least a year and a half or so, but during maybe a 3-year period, they all got back on the same page as they went from market making to algo driven, okay, market making. And you can see that, by the way. Let me show you one other thing.
All of the months except June are now actually lower than they were before that little episode.
Yeah, but longer term, right? And you can understand. Okay, while I'm on this, let me just comment on Andrew's comment. Is that over time, what you'll see is that these lines should end up going from upper left to lower right. They should end up dropping. If I end up coming on a 3-month, right, on a 6-month period, look at how this is normal, right? It's normal that the longer term VIX futures are going to be much higher, and over time they're going to end up dropping because they're saying, okay, we're not so fearful that the market's going to have a huge move over the next, 1 month or 2 months. 7, 8 months, we can't see that far. Okay, so you'll see these types of movements from upper left to lower right. And so when you say that things are lower than they were, let's say, 3 weeks ago or 2 weeks ago or a week ago even, it is a normal phenomenon. It's when you see things like this. This troubled me. This did not trouble me. Look at the jump that we ended up having in the futures. And if I were to show you, now remember, This blue line, I already told you, was May. Back over here, we had the Aprils still in play, and back in here, we had the Marches. In April, April actually jumped up above, okay, in this part, it actually jumped up above the Mays and the Junes. And so we were actually in backwardation in the first month, and during one day we even got in backwardation during a second months 2 and 3. And so this was an area where if things got to be really ugly, it was going to end up jumping. Now, if you guys remember, what caused this was the French. They're not primaries, but the first round of French elections, where there was fear that if Marie Le Pen, the conservative candidate, won, that she may try to end up taking France the way of Britain and leave the EU, and that would have been a major disruption. Okay, you know, the Comey Trump dance. Yeah, no, yes, I understand. Can't end up speaking to our enemies. Okay, beforehand, you take a look at what had happened, but it to me. It's again it's more it seems to me more political going left and right than what's actually going to end up affecting the economy. Okay, whether or not what was said on what phone call to the Russians doesn't have a major impact on earnings, exchange rates, actual economic growth. France leaving the EU does. Okay, so put things into perspective, and if you start to end up thinking about things more as a from an economic point of view, it will end up having a bigger impact. What I was going to end up showing you before I went on that little side trip was the following. If you take a look at, and I do not like this, I do not like to use the skew index that the SIBO publishes as something that becomes very useful to us. It's only over a certain period of time, like the VIX is a 30-day period, the skew is a certain day period. It only looks at specific options. It doesn't end up telling me enough of how the curves are morphing. So I think it can actually end up being, if you look at it, to actually make trades, it can actually end up being misleading at times. And that's why I don't want to end up talking about it a lot. However, the reason why I'm bringing it up here is each one of these dots, and it's a number. You also need to know that the skew is published once a day at the end of the day, okay, by the SIBO. And each one of these little dots is where the skew is for that day. You can see that we've had a lot more of these high bursts in recent years. Yes, this is a multi-year chart, 2011 being here. What you're looking at is that you're looking at a 50-day and a 200-day moving average. Okay, so I'm trying to show you something as a long term. And what you can end up seeing in the 200-day moving average is that over the last half decade or so, or even a little bit longer, is that the skew had been pretty normalized in the 120 area, okay? But, starting in, because it started to move up here, started to moving in, mid 2013 for the next 3 years, we have moved higher on the skew. Now, skew has gotten steeper over the last several years, and you can end up seeing this, okay, on a trend line, a long-term trend line. So if you've done a ton of back testing back here, and you say, well, I know what's going to end up happening here, I can end up telling you that it doesn't act the same way. Why has this skew gotten steeper? Computers, okay, algos, high-frequency trading. Again, people have asked me to share different things. I can't end up sharing a bunch of stuff because I'm still under non-disclosure, but I can end up sharing this, that many high-frequency trading firms, they trade VIX and VIX-related products more than anything else, at least in terms of the commissions that they end up paying. Okay, they're absolutely huge. And the reason is, one, it's a low-priced index. Two, It moves around tremendously. And the reason why those things are so important is that high frequency guys make their most money when markets move. Okay. Um, Andrew, or anybody else, I want to open it up to questions. Want to end up taking anything that other people want to say. Paul, I know that you're on. I don't know if you've dialed in, but I'm going to open up the floor. Andrew, any points that you'd like to end up starting with?
I have a question for you, and that is, do you think the popularity of the concepts behind the book The Black Swan have contributed to people being more interested in buying volatility? I noticed that, over the last couple of years, it's been a topic that's come up at capital discussions and other forums where, you didn't hear about that years ago. It seems like people are a little more concerned about black swan events, and maybe people are just buying more puts than they did, 5 or 10 years ago.
I think that the retail piece plays a part, but I think it's a minor part. Okay. A couple of quick points. Number one, before the 1986 crash, yes, I did say 1986 crash, there was no put skew. It was evenly distributed. After 86, okay, we realized that we can go down much faster than we can go up in the market, and hence the skew was born. What had probably the single biggest effect, okay, um, back here, it's twofold. Okay, there are two major pieces that ended up having an effect on this. The retail Black Swan books are not one of the two major effects, but it is one of the effects, just more minor than the two major effects. The first major effect, okay, legislation. What happened after the financial crisis of 2008, we went into reform and we ended up having a number of different bills that were passed about how much leverage banks could end up taking. That leverage went far beyond their ability to make mortgage loans and to securitize them and to pay into other places. They didn't take a lot of losses on that, by the way, the bigger banks, because they securitized them and they sold them to places, to larger money management institutions. Think sovereign funds. Think big pension plans. If you go and you take a look, for example, what happened to Iceland. I mean, they just got absolutely devastated as they got deregulated. So what happened was that as we re-regulated ourselves, banks were not allowed to end up having as much leverage. Now, if banks can't end up taking leverage, that ends up meaning that they can't end up giving the broker dealers and investment management broker dealer, especially the dealers, they can't end up having the same amount of leverage that they would give to their clients, the hedge funds and the money managers. So therefore, margin rules changed. If you guys end up remembering, margin rules when they first came out on the S&P 500 were you had to end up putting up as much margin as you could possibly lose at any point in the trade if it moved up 6% or down 8%. That was the rule that had come out from FINRA and the SEC, or however they ended up getting to it. But broker dealers started saying, no, you need it to have more. Thinkorswim does more. Everybody does more now. And what's happened is that even the big institutions got bound by financial rules, and hence they weren't allowed to take as much risk. How did that affect the S&P 500? Well, that's pretty easy. If I'm selling naked puts, all I have to end up doing is going and buying a teeny someplace far below the market, and now I can end up defining my risk. It might be a lot, but now at least it's not unlimited down to zero the way it was. So by doing that and changing the regulations, the government basically forced many of the large money managers and actually even us, right, forced us to end up having more risk controls on the downside, which meant not leaving things naked or not having as much risk if things ended up moving significantly. That drove the tails up. That was number one. Number two, high frequency trading, okay, and algos moved from the equity worlds into the derivative worlds and then into the listed derivative worlds. Right, meaning what we end up trading, listed derivatives, S&P 500. And what they ended up finding was that they always knew they made their most money when markets moved. Okay, they need movement in markets for them to end up making money. And they know that markets can end up moving down significantly. They never fear, right? They never fear Brexit type movements. I was actually, it was during Brexit, right? It was during Brexit. And let me just come over to here for 1 second to show you again Brexit. Okay. I was doing some consulting work at a high frequency trading firm during this. And we had conversations during this week because I worked this week, okay, beforehand. Um, for those of you who don't know, I know I shared this. I was actually on a plane during this. Okay, my daughter goes to Boston University. She's spending a summer in London, so we actually landed in London on the day of Brexit, which was kind of fascinating. But we had the conversations with the high frequency guys during this time, and they love these types of events because what ends up happening is that when the markets move and there's any velocity, they're faster than anybody else. Okay, they make a ton of money on this, and so one of the things that they could end up doing is that where won't they make as much money when you end up getting this back and forth, back and forth, back and forth in this area, back and forth. Yeah, they're making money. Don't get me wrong, they're making money, but they're not killing it the way they are on movements like this. So what do they end up doing? They sell put spreads. They can't take unlimited risk. Okay, they have limited capital because they don't take capital from outside investments. Okay, all of their capital is inside, institutional money that they end up having. And hence, when you sell a put spread, think about what you do when you sell a put spread. You sell a put closer to the money and you buy a put further from the money, right? So that means you're going to push down the volatility closer to the money and push up the volatility further from the money. Hence, those are the two biggest factors, the high frequency trading effect. And I gave you one part of it, right? There are other parts of high frequency trading, but the two biggest effects that have been in the market are regulatory, okay, where they've had to buy puts, and high frequency trading that tend to end up pushing up again volatility. And they have regulatory also, right? Because they don't have limited amounts of capital. Everybody's a limited amount of capital. Um, it ends up driving vols down closer to the money, pushing them up much further below the money. Uh,
Volatility has also become an asset class.
the other part, okay, the institution is the asset class piece of it exactly. This used to, and people used to say, well, the tail can't wag the dog, meaning that these ETFs or ETNs, the VXXs, the XIVs, they can't end up driving the actual volatility in the market because those are the S&P 500 options and those are the VIX options. Well, they have so much of an influence now, and the high frequency guys use those. That yeah, I mean it's. I'm not saying that the tail is wagging the dog, but that tail is a pretty damn big tail. Okay, there's a lot of money in there. Now, granted, it's not as leveraged; it's retail based, which means now all of a sudden it's not just institutional anymore. Now the institutions, the high frequency trading guys, are trying to take advantage of the arbitrage opportunities that they have in between those asset classes, the VXX, the XIV, and the VIX futures, right? Because they can end up playing both sides of that thing because they're formulas. And so, yeah, that brings up volumes huge, huge. And once they have enough volume, then they can end up establishing larger positions, which means they can do more high frequency trading on them. And so, yeah, these are the types of things. Now, this game is not going away. Right? It's not going away. Okay, the steeper put skews that we've ended up seeing are going to be here to stay. The very, very fast movements in the markets are here to stay. This is, I think, a terrible thing for our old standard friends. Things like, wider iron condors. You need to be quicker, more nimble. It's going to be more commonplace going in the future to end up having these very big drops very quickly or these huge gaps up very quickly. So if you are a negative gamma trader, now remember what a negative gamma trader is. Negative gamma trader says, I don't want the market to move. You know, it's right now we're at 2388, and I want it to stay here. I don't want it to go anyplace because this way I can collect my theta, I can make my monthly income, and I'm going to be happy. Um, the problem is that for the guys who wanted to make money every single month, that's going to be a lot harder. Okay. You're going to have to end up taking a look at your risk reward ratios. And unfortunately, you're going to have to either accept less money if you're going to end up be willing to, if you want to end up winning every single month, if you're willing to take bigger losses, then you can end up making, a lot more money per month. Okay. I've been playing around with stuff in the rut, much, much, much narrower butterflies that make a lot more money if they stay within them, but I lose a lot more often. But in the end, my profitability has actually been pretty decent on it. But you know what? Never be a good service. Why? Because oh God, my win loss ratio is probably only about 60%. Who could ever afford losing? Well, you know what? You're gonna have to change your thinking a little bit, okay? Because you're gonna have to think longer term. You might have to end up investing smaller because your win loss ratios are going to end up changing your long term equity growth curve in your account. You're not going to be able to end up trading the same old ways. Same thing with hedging. I'm not going to end up doing it again here, but I did do it on Thursday. I ended up showing a hedge that I ended up using with VIX futures. VIX futures, we did a ton of work when I was working at EAB Investment Group to try to end up finding how's the best way to hedge the S&P 500. And using VIX futures is not. Okay, it is not. But there are situations when it is. Learning your different situations and what trades and what hedges to use in which situations becomes absolutely critical. The reason why the VIX hedge worked so well was that I kept my May trade open. Okay. Um, the only risk I ended up having is if we had like an overnight 50%, 50-point drop in the S&P, in the SPX, which we did. And so when you have a 23-year low on the VIX and the term structure, meaning the longer term VIX futures are still expensive, buying a call vertical on the VIX is a great hedge if you only need it for a week or less and you're only going against a really big move. Well, that was the only time I was going to get hurt. So I matched my hedge to my trade. Right? That's what people have to end up realizing, that they want to have these one size fits all. And unfortunately, with the high frequency trading and what's happened, using this one size fits all trade going forward is going to become more and more and more difficult for you.
Is it now a waste of time to back trade before 2013?
I think so.
I,
I
Paul,
I
I
I,
agree with Paul. The only thing, the only caveat that I would say, then a flat out, I definitely think so. Also, is that it does give people a feel for at least types of movement. Now, those movements are in slow motion to what they're going to be. If you build your back test saying, well, okay, I don't have to worry because the market's never going to end up moving more than, say, 3% in one day and 7% over 3 days, you're going to get killed. And I don't, not only don't I think back testing, okay, if that's what you're looking to figure out how to end up doing, not only do I think it's not good, I think it'd be detrimental and I think it would be harmful. But if you're just looking to try to end up understanding, well, if in a more basic sense, right? If you're a newer trader, okay, understanding how markets can continue to end up moving, let's say in 2008, it's kind of important. You just have to realize if we ended up facing another financial crisis like we did in 2008, if you thought 2008 moved fast, this is going to end up moving so much faster at this point that it's just ridiculous. Remember, this was a 50-point drop. We didn't go into backwardation into the VIX futures. Okay, the put skews didn't change that much. It wasn't even like this was a big deal to the indicators that you take a look at because it was an event risk, and so it was kind of blown up. But it was a 50-point move. Okay, had this happened 4 years ago, it would have been a bump. It would have been a bump. Yeah, there would have been some selling, but you're moving so much more now. And so, in that sense, when Paul said, I think so, I couldn't agree with Paul more about how much faster things are going to be moving in the future.
Well, one of the things that back at the beginning of 2013, the Russell was $852. A 1% move when you're back testing at $852 is much different than at 1400. So, if you're developing a trade, it's okay to go back to get the feel for the thing to make sure that it's going to work. But I'm back testing 2015 and 16 now, and that's as far as I'm going to go. It's because things have changed. On the topic, Andrew asked about the topic of the VIX trading. Well, my opinion is that's become the trade of flavor at the moment. It's it's a pretty crowded trade when you look up the XIV and find that it's got like 94% institutional ownership. So people are buying and selling volatility as the trade that they think that they're going to make a lot of money on, which they do. So everybody's searching for the trade that's going to make them a lot of money. And I think right now it is in the volatility side of things. Just look at the open interest in the fixed options. Everybody does it.
Everybody's huge.
And they lose just as much as everybody else. But they've got somebody that's written a white paper that's convinced them that it works great. So, things will change. There'll be another flavor of the month at some point, and they'll all rush into that, trying to make some money.
It's like, for example, I guess it's almost 2 years ago at this point. If you take a look at the end of August 2015, look at where the VIX is here. Higher than at any point during the last 20 years other than the financial crisis. Higher than any point during the dot-com run-up, the dot-com bust, the Treasury, not the Treasury, but the debt ceiling vote that ended up causing anything. Look at how high this one spike was. And unless you have some severe battle scars, and I know, Paul, this is a very sensitive topic, unless you have some severe battle scars during this time, you didn't even notice it. Okay, it's like I don't even remember what ended up happening there. It was like, well, maybe something might end up happening with China. I'm not sure. It was boom, the VIX was above 50.
All right. I know exactly what happened.
You do.
I lost money.
Okay. Okay.
It's going forward. It's basically it's how do we? To me, it's how do we manage what we're doing, and I'm trading for a living has become very complicated, but it's how we're going forward and what we look for. I just want to. We have had 3 Hindenburg omens in the Russell this month.
Paul, not everybody's familiar with that. Would you explain what a Hindenburg is, and do you need the ball to explain, or?
Yeah, I can. I mean, they can look it up on Wikipedia. Somebody developed it. He wasn't happy that it was named the Hindenburg omen, but I've got a graph that shows it.
Hang on, let me get.
And I'm going to try and I can do my best to explain it.
Let me stop sharing, and let me get. Let me find Mers. I got to search.
Yeah, just look at the bottom of the list. I'm usually always at the bottom.
Sorry. Not there. Oh, crap. I can't seem to find. Oh, there you go. Hang on. Change row. Okay, you got it now.
Well, I don't seem to have it yet.
I don't see it either. I did, but I haven't.
Right click on my name, and you can make.
Yeah,
it
I did. I
present
tried
it.
doing that, and then I hit it, but it seemed to be grayed out. Let me try this. Let me do it this way. I should be able to get it this way. There it goes.
Ah, okay. Okay. So basically, from my understanding, to create a Hindenburg, you need to have the percent new highs higher than 2.2%, and the percent new lows higher than 2.2%. And it needs to have a rising moving average, and the McClellan needs to be less than 0. And then the new highs are less than equal to 2 times the new lows. And you can see there's been 3 times that it's hit. And it's only hit in the Russell. It's not. I also track the S&P 1500, and it's not triggered on that, or the NYSE. But I found it interesting that it has hit in the Russell. So, this is a caution.
And the Russell's been weaker
Yep.
than all the other indexes. Remember, the Russell was the index that ended up just tearing, higher off of the U.S. election, and was just huge. I mean, it outperformed everything. But if you go since the middle of December to now, it's moved sideways to flat, while the large mega cap technology companies, and hence the NASDAQ 100, has just been on a huge run upward. The Russell has not. When you start to get these types of divergences of large cap, small cap, different industry groups like this, and most importantly, the breadth narrowing, that's kind of what the Hindenburg is saying, at least in one of its tests. Are you having more new lows than you are new highs? If you're having more stocks end up actually selling off than are moving higher, and if the only ones that are really holding the market up are a few mega caps, that's not a good omen.
Right.
That's exactly what ended up happening towards the end of the .com boom.
Now, the caveat to this is that it's from everything I've read. Hindenburg does not mean that the market's going down. You can have Hindenburgs and the market doesn't go down. But in history, a correction has always been preceded by Hindenburgs.
So one implies the other, but not vice versa.
Correct. This is not an indicator that, we're going to have a correction.
So
but
this is one of those indicators that's predicted 10 of the last 5 corrections.
Correct.
Good way of putting it, Andrew. Yes.
that's exactly right. But all 5 corrections have all had Hindenburg. So basically, how I use this is by, when I start seeing these showing up, trading lighter. I'm trading with a little bit of protection, one or all of the above, just in case, because you just never know. We haven't had one for an awful long time. There were none back 2016. See if it goes to 15. What's interesting was it's through 8.4. There was none even for the correction on the 15th. So, it's kind of a hit or miss thing, but it is something that I watch just to keep my eyes open.
2015 was the last time I max lost an M3.
Yeah, and that was actually kind of a surprise event because it had to do with the computers and the very thinly traded ETFs. I believe it was SDY was the one that got hit the worst. So I've got skew graphs if you want to see.
Yes,
Actually,
please.
not bad. So here's today's, and did update it to 517. So this is the big down day, and this was the days leading up to it, and the reds today.
Yeah, that's what we were talking about. Remember, I had mentioned, Paul, before I said that I was talking to the EB guys and other institutional guys, and that what we noticed is that the steepness of the put skew didn't get, significantly flat. It didn't significantly change its
Correct.
its direction.
What I've been noticing watching this is that when we have a correction, it's been doing this.
Mm-hmm.
It'll take a few days to get it to flatten out. But the initial reactions, the whole thing just moves up. So you don't get any relief, from your long calls in your at the money or in the money puts in the butterfly. There's no relief because the whole thing is moving up.
Yeah.
It's a little different. Here is, I believe, 8-3. Yeah, so this is the infamous day, right? 8/24 is the last day, which is here. And this is today, but these are the 15 trading days prior to 8. So you can see how much flatter we were compared to today, back in the beginning of August of 2015. This was what our trading environment used to be. Now this is our trading environment. So just keeping things in perspective of what we're seeing now. I'm hoping we get back to looking like this. We'll go back to normal. I keep waiting.
How does that go back to like 2012?
I have beginning of 2011. So I think so. Yes. Or would you like to see a date back then? I'll see if this thing will work.
Yeah,
It doesn't matter because 2012 was just a different environment.
Right. So let's pick 2012.
The reason why Paul said, let's see if this works, is that everything's in a database, and so he's doing a huge load right now. He has to reload all of the data in this very big, complicated Excel spreadsheet while he's running WebEx, while he's speaking, over the phone on it, and the bandwidth is just is really beating him up right now.
So let's see. So that'll be a 32-day DTE. That should work good. So I think this is
all data that's stored locally, so it's just computing power, right?
Correct. But right. I don't have this. This is on the machine. The only problem with the machine is it is competing with TOS, which is a memory hog, and the other spreadsheets that are open that are live data. So there's the skews for that particular time frame.
Much steeper skew.
Yeah, but look at the bottom. There was much more premium in the at the money strikes than there is today. But you're right. This was much steeper. This is back.
It's also the lines aren't as smooth.
That's correct.
Right. And by the way, right there is another fact that shows you that the computer simulated trades, because if there was anything that would get out of whack a little bit, computers smack it back into line right away.
Right. And this is because the price, I mean, you've discussed this, Jim.
Yeah.
When you get down to 10-cent um, pricing, the mid prices get all out of whack. So it leads to these jagged lines. But you look down in here, which is below the money and above the money, not too far, they smoothen out because the prices are higher. But you still get kind of a gauge as to what history looks like versus today. And that's all I'm doing with this is I'm just kind of trying to look at comparisons to, what my environment is when I'm putting on a trade. That's why I do the spreadsheet with the pricing of the butterflies.
A pretty graphic representation of why the results are so different.
Now than prior. Yes,
Right.
absolutely. I mean, even if you go into like January or of this year when all my trades were working, it's different than it is right now.
That higher volatility meant so much more theta.
Mm-hmm.
Right in here. I mean, this is the last, right, from April 26th forward. So you were collecting, there was more premium here back then than there is today. I think being more opportunistic on the trades and taking the money when you get it is kind of the new way that we should be looking at trading.
Mm-hmm. Agreed.
It certainly was the thing to do last Wednesday if you were short.
Mm-hmm.
Right. The butterfly pricing got very, very good yesterday, that day. Today, they're actually not too bad. The problem I find is, what's interesting, I don't know what it's like today, I haven't done it, but if you take, like this is 30 points above the money, 20 points below. So if you take and model this butterfly and then model one 10 points lower and look at the difference in prices. I've seen it days where it's $1.50 difference. So if the SPX moves up 10 points, theoretically you would, on a 10 lot, you would have a $1,500 loss on that butterfly. And so the question becomes, does the call on an M3 moving up 10 points, can that make up that $1,500 difference? Now, I have to go back. It's time for a new spreadsheet so I can compare side by side, 10 points below and historically what 10 points below would be.
I look at Paul. I'm sorry, Paul.
I mean, we look and see what today is, but what's the average? If the average is $1.50, then there's no problems. But if the average is less than that, then that needs to be a consideration when you're building. I've my last fly was an 8 lot with a long call because of what I saw, and even that's struggling. So I don't know. I think when these get low, when it's all, I bought VIX puts when the market went down and closed them right away. I didn't make a lot of money, but I made some money. You just have to see an opportunity and be there to take it.
Okay, we're going a little bit more than an hour. Paul, anything else that you wanted to end up sharing or commenting on?
No.
Okay. I had gotten asked about and this came to me, Paul, not you. Is this a better environment to trade Weirdors? Because I guess they saw your Jeep that you
Oh,
ended up
yeah.
having.
That's I'm leaning. Let's see. So I posted to my trading group that I've got a couple of butterflies to take off, and then I'm going to become a Jeep dealer. It is with a caveat. This what you saw was an SPX Jeep, which has a completely different management, and I think you have to take into account IV skew. I'm taking into account a lot of things: ATRs, IV skews when I set them up and when I adjust them, what I do. But I think that anything for me right now, they're much more stable. The trade is up fairly decent, and I don't think I've been in it that long. Let me take a look.
Well,
Let's see.
okay.
Yeah, it's 3 weeks. I've been in that trade 3 weeks, and
couple of quick comments about the Jeep, and then a question to you, Paul. Quick comments are, the Weirdor Dan Harvey originally designed had to be maybe about 7 or 8 years ago.
yeah.
Um, Stephen Shannon and I ended up trading it. We were trading partners for a long time. Paul and I ended up working together. We ended up, Steve and I ended up calling it a Jeep. Okay, Dan Harvey called it a Weirdor. We had slightly different rules. What Stephen and I and Paul all found out some years ago, probably about 3 years ago, is that because of the way skews had ended up changing and the way IVs were moving, and the markets ended up moving, that the Jeeps became much more difficult to end up trading than did some of these broken wing or butterflies with long calls. And Dan and I both ended, and Paul did also. We all ended up changing the way we ended trading because it was easier. But what's been happening with the conversion of the high frequency trading and the effect that we've had is that we can't end up using the same rules that we used to use for the Jeep. Paul ended up going through, and he just mentioned a couple of things that he's looking at. Paul, if you would be ever so kind, I'd like to maybe set up a round table where you can end up kind of talking about the old Weirdors and Jeeps and the challenges you end up finding, and maybe some of the newer things that you're doing. I think there'd be a lot of interest in why the old Jeeps still aren't working, but the way the modifications you have made, and this hasn't been driven so much by Dan Harvey or I. This has been Paul, and Paul's like presented us ideas that seem really, really good. Would you? I don't know if you'd be willing to, but would you end up? Could we set up a round table?
Sure, that sounds
Okay.
fine.
Okay.
Yeah, I've abandoned the rut obviously after spending hours and hours and hours back testing that. But the new this new strategy in the SPX has to be completely different than what I was doing or what all of us were doing, because we were all in the rut doing it. At that
Yeah.
point, there was some incredibly good premium, and the rut has just got out of control. It acts more like the NDX than it used to.
Yeah. The rut can end up being very difficult these days. I know.
I spoke to someone this morning about the rut, and I said, I abandoned the rut after we had that 2.3% up day. I mean, I can understand a 2.3% down day, but a 2.3% up day?
It's funny, Paul, because one of the things, and I haven't shared a lot of these trades with you, I will when we talk this week, but I've actually gone back to the rut with very narrow butterflies, because this way, if it does run 2 or 3% on me, my losses are capped. They're going to be relatively small, and what I'm doing is that my winning percentage is much lower, but my losses, I'm taking these losses, but I'm able to end up capping them by making my butterflies narrower.
Right. I think that's a good idea. And I think one of the things that doesn't get discussed a lot is um, the win loss rate. Dan Harvey is really really good at this, and it'd be nice if he spoke on it as well. But your expectancy rate on a trade is very important when you start doing that stuff. Is to understand your win loss ratios, and because it ends up becoming you take more losses in trades, but your it's not your win loss rate, it's how much you lose versus how much you win, and that's really important. And we tend not to focus on that stuff. We're all focused on trading strategies, and trying to earn a living and keep preservation of capital at the same time. You really have to do that.
Yeah, you definitely do. You definitely do. Um, just I don't know if everybody understands what expectancy is, and this will be the last thing. And I know we're over. I'll ask for last questions, but the last comment I'll end up making on this is that expectancy is your winning percentage times the amount that the dollar amount that you win when you win trades versus your losing percentage times the amount of dollars you lose when you lose. Okay. And so I think that most people end up obsessing about winning percentage, and they really should obsess about expectancy, winning percentage, and what's my average winner, what's my average loser. If your average loser, and the challenge with the historical Jeeps are, if you do nothing, your losses can be outrageously large. So therefore, you have to end up taking action. And unfortunately, the way we used to be able to take action, where it was that we could still end up getting good pricing, but what happens now is things that move so fast and volatilities and skews change so quickly that we don't have the same ability to make the same type of adjustments. Hence, you need a new approach, and that's what Paul agreed to share with us. Any other thoughts, questions, comments? Okay, guys. Thank you very, very much. Andrew, Paul, thank you so much for signing in. And please, other folks, okay, for next week, if there are specific areas, if there are trades, I'd love for you to end up just asking questions. Jim, would you take a look at this? Paul, I've been trading this thing this way. What are your thoughts on this? Okay, that's what we end up doing this Monday Market Muse for. It's basically to end up sharing information, sharing insight, and sharing experience that we have. Thank you.